Well, for Don's question, he said a question that keeps presenting us was whether to collar a long stock position or just buy a put. Okay. Also, if I have the collar or the long put by itself, when do I close it? Since the implied volatility after an event like earnings or a positive reversal may drop significantly the long put value. Lastly, if I'm in a collar, when should I buy to close if the equity is going up? Okay, so let me leave this here. And what we're going to do, folks, we're going to navigate over to Power Options. We're just going to take Don's question quickly. I'm going to make some base assumptions on this before we get to everyone else's questions. And let me see here. There we go. Perfect. Okay. So here we go. We're going to navigate over to Power Options. And what you're looking at here, of course, is the 14-day free trial. Those of you who maybe just started the 14-day free trial, I encourage you, of course, to take advantage, oops, didn't want to draft that, of the 4 steps here, the quick start guide, flash tutorial, free webinars, live webinars, and archived webinars as well, and of course, the free coaching session. Now, we've already talked about the married put position, and that's what Don was talking about. If he just had the long put, if he was just in a stock with a married put position, in this case, and we're looking at a standard, just basic married put, we do our structure one way. I'm not sure if Don was talking about a standard collar position or if he was talking about a married put collar position. I didn't get the email back from him before I had to log on to the webinar. But let's just take each individual one. A standard married put, whether it's a radioactive trade or you're doing something shorter term. And Don was curious to know in a case is that, okay, first off, when would I do a married put or a long collar that would look like this, a standard collar position where the bought the stock here, sold an at or just slightly out of the money call, bought a further out of the money put. So you probably got a risk of 4% with a potential to make a 3% maximum return. So the first question is whether to collar a long stock position or just buy a put. Right here, just based on the 2 graphs, you can sort of get your own answer. Let me draw a better graph there, okay? So there's your married put, and of course, here would be my standard collar, usually 30 days out in time. If you think the stock's going to be a strong performer, Don, whether short-term, longer-term, you're expecting a 5, 6, 7% increase in the stock position, whether it's 20 to 30 days or maybe more, I would just use a married put. If you you like the volatility of the stock, you like the premium that's available, and you think it's a good neutral to stable stock for 20 to 30 days, but you don't have a longer term outlook for the position, that's when I would use the standard collar position. Now, your follow-up. When do I close it since the implied volatility after an event like earnings or positive reversal is going to drop significantly? Well, if you're in the proper married put structure, what we looked at with FNV, if I'm out at least 150, 200 days out in time, we looked at a January example if we bought on April 1st. The near-term earnings events are not going to affect the volatility of those farther-term put options as much. The near-term are going to be most affected. What does that give you? Well, that gives you good premium on the collar, but remember the increased premium you're going to be receiving for a short-term collar, standard collar position around earnings, is also going to increase your put price. But you're still probably going to get a good call premium and a good put premium and still can control the risk to single digits while having the potential for hopefully a high percentage signed if the stock gaps up in price. Okay? So if I'm in a long-term married put, I'm not worried about near-term earnings. I'll get a slight bump in implied volatility leading up to it, and then it'll drop. If you're using a 1-month out put and you've got earnings coming up in 10 days, yes, the implied volatility of that put is going to increase, and it runs the risk of decreasing drastically after that earnings event. We only have 20 days left to expiration. So when would you close it? Well, what happened? Okay, if I'm in a married put, Don, that's only 1 month out in time, a standard married put, not what I would trade. If I'm just in a standard married put that's 30 days out and I've got earnings coming up in 10 days, the volatility starts to creep up, but after the earnings, the volatility drops down. Well, you have 2 choices now. Either you liquidate the position, hopefully it went up for you, but if it went down, you had a low single-digit risk, hopefully, so you liquidate the position. Or you buy another put for the next month out, which is going to add to your cost basis to continue the position. Depending on what the stock did, gapped up, gapped down in price. If it gapped down, I might sell to close this put, buy a lower put, and then turn it into a collar after the earnings event for the next month. If it gaps up, I may just liquidate the position for the profit, even though the implied volatility crush occurred in that near-term put option, which wouldn't have affected the farther term as much. Okay, so those are some of the things that you want to consider in that case about when would I look to close. Well, I'm struggling here with something. Sorry, okay, I'm not going to mess around with it anymore in that case. So depending again, are you looking at near-term standard collars? Are you looking at near-term married put positions? That's sort of what I look like. If I'm in a far-term married put as described by the blueprint, I'm not overly worried because the volatility effect isn't going to be that much. My put that's 200 days out is not going to be affected as much as an event coming up in the next 10 days. There'll be some, but not a lot. Okay. All right. Lastly, if you're in a collar, when should I buy to close if the equity is going up? Usually we follow about the 1% rule. If the stock moves up above 1% above our short call strike price and you want to stay in the position, that's when I might look to roll the short call on the collar, standard collar. If your goal for the standard collar was just to make that 2 to 3% on in the first 15 to 20 days that you were in the position and it moved up above it, is it worth rolling it? Or are you just going to be happy to take your 2 or 3% return? Once that's closed out, look for a new position. Okay. If you're in a longer term hold, and let's say you do have this long-term radioactive trade and you sold a near-term 20 to 30-day out call and the stock was one of the ones that Todd mentioned, FNV, ATVI, well, the blueprint does talk about using income method number 2, the guidelines for rolling up the short call, but yes, if you think it's really going to take off, you have this thought that the stock's going to gain 6, 7, 8% and you're in a short call right now, you may want to take the bite, buy to close the call for a higher value, and then just leave the upside open. Okay, but again, like we said for Todd, that comes down to your risk tolerance. General guidelines for me would be if I'm in a standard collar and I want to hold on to the stock, or if I'm in a married put, follow the rules in the blueprint, but once it goes a little bit above my short call strike price, maybe 1% above the short call strike price, or maybe moves to the next strike, I might look to roll the call, maybe even close the call if I'm expecting a larger move. And exiting the married put after earnings, whether you're short term, again, that depends. You might see a volatility crush, but it depends on what happened. If it went down, you want to stay in the position. When you sell to close that put, buy a lower strike put to still have a low risk position, hopefully, but you'd be going 30 days out in time. But if it gapped up and you've hit your goals, you might just want to close that shorter term married put position rather than trying to re-bracket it and move further on as well. Okay. Oh, Don, standard collar. Okay, so there you go. Did answer that right, Don, with the standard collar position. Good. Okay, so a standard collar trade there, Don. As I mentioned, I would not necessarily look to roll the short call if the stock moves up. Again, if the stock moves up as I expected on the position, and I'm at my max return, I may just let it go. I wasn't holding this for a long-term gain. I did the short collar because I liked the premium. I thought the stock was stable to neutral, and I wanted to get a reasonable return but control my risk on the trade. Frank, I don't really understand your question. I'm going to ask you to clarify this. This was asked at 4:30. I hope you're still here. Frank said, can I use an out-of-the-money put to protect an at-the-money bought call and at-the-money sold put? Oh, I'm sorry. Now I get it. I get it now. Okay, so you're talking about a synthetic stock position with an out-of-the-money put. The answer is yes. But you can't have the put, of course, be the same strike as the put that you sold. I know you know that. You said an ATM put and an out-of-the-money put. So what he's talking about is a synthetic married put. Usually would be done shorter term, not long term. And I wouldn't use OTM. We don't use out-of-the-money puts in the radioactive trading technique. So we'll go back to our F and V position here. Oh, it is at 140. So I'm going to buy the 140 call and sell the 140 put. Okay. Yeah, let's clear that one out. So what does that give us, folks? This is the synthetic stock position. Okay, there you go. Mimics stock ownership. Hopefully it can be done at a credit. Sometimes it'll be done at a small debit depending on the stock. Now, absolutely, Frank, at this time, what you could do is buy an out-of-the-money put, same expiration. And let's just go to the 120, 125. Now let's go to 130. I know it's expensive, but we'll keep it a simple 10-point spread there. And now what essentially you're going to have, Frank, is a synthetic out-of-the-money married put. Let's just put this at 163. Keep the math a little bit more simple. All right. Now you've got a debit. about 203, the 40 cents from the initial synthetic and the put. Now you're risking $1,200, okay? But that's $1,200 on a stock trading at 140 or 14,000. You're guaranteed to get 13 back. That's the most you could lose, is pay out the 13,000. Essentially what you do have is a bull put credit spread with a long call. That's really what it is. But yes, this creates a synthetic married put position. Perfectly fine to do it in that fashion. You shouldn't take on any other risk or margin, and it actually cancels, doesn't it? Cancels a lot of the risk of having the naked put, which you'd have on the synthetic stock position as well. Okay, so that's perfectly fine to do that. What I wouldn't choose to do, of course, is sell a call against the synthetic, because now I've got a naked put, a naked call, and an extra long call. Well, it'd be a bear spread, essentially, with the extra short put as well. Okay. Okay, Richard, this is a quick question here related to just options concepts. And he says, I have a hard time understanding why a tight spread is better than a wide spread. And how wide is too wide? Okay, so Richard, in the sense here, I think you're just talking about a credit spread. At first I thought you were talking about bid-ask spread and why I'd want a tighter bid-ask spread, and I could use the search tools to find a tighter bid-ask spread. And the reason we like a tighter bid-ask spread in that situation, bid-ask spread now, not spread strikes, is because you're more likely to get filled at midpoint. Okay, if you have a lower bid-ask spread, you're probably going to get a better fill price. Okay, now what you're probably talking about, I went to covered call. What you're probably talking about is more on a put spread. And if I go into the search here, we are just going to take a quick example. And Frank, sorry, just real quick for Frank. You also said, is that better than just a bought call? Well, it depends on what the cost was. Oh, Richard, okay, I'm sorry, guys. Frank, it depends on what the cost was. By just buying the call itself, you know what your max risk is and what your max return could be. If the stock moved up 10%, 12%, you could calculate it. In the synthetic version, you've got 3 working option legs now, which are going to have delta differences and things of that nature. But it should be close to the same risk reward. So I bought that 130 call. I apologize. I bought the 130 put against your synthetic, and you saw a risk of 1203. If the long call at the 130 strike is only priced at $11, I'd be more apt to go ahead and buy the long call. Compare the two. Compare the max risk of your synthetic with the cost of the out-of-the-money put. And if that risk, let's say it was $12, $1,200 on our example, is lower than the cost of the call at the same strike, that 130 strike we bought. If the cost of the call was $14, then yes, I'd be using the synthetic. If the cost of that call is lower, it's only $11 compared to the $1,200 risk, I'm more likely just buying the call. Okay, that's it. They're parity trades in a sense of one another. They come down to that level. Okay, so won't go to this route. I did want to go to the covered call. I'm going to go to weekly picks of the day. Oh, I'm sorry. I wanted to go to search. All right. So, by default, Richard, most of these searches that we have in Power Options are going to be based on already screening for something that has less than a certain monetary value bid-ask spread or a percentage bid-ask spread in this case. That's 50%. What does that mean? Well, the percent bid-ask spread, it shows the bid-ask spread of the option, of course, expressed as a percent against the bid price. So if I have an option that's trading at $1, the bid is at $1, using the 50-cent bid-ask spread percentage control, the ask cannot be higher than 150. So if it was at $2, it'd be 100% of the bid-ask spread. Okay? We want to keep it closer to get better fill prices, especially with the weekly options. If I do a weekly search for bull puts or even cash-secured naked puts, Richard, and I've got a $50 stock, let's say I've got two $50 stocks, and one's got a bid of $1 and an ask of $2, and the other has a bid of $150 and an ask of $350. in reality, I'm more likely to get $1.50 or close to it for that midpoint price on that one, as opposed to trying to get the midpoint on the spread that's $2.50 apart. I'm probably not going to get $2.25 or $2.30 on that spread. As soon as I put in the order to sell it at $2.25, I'm going to see the prices in the exchange change to where the bid stayed at $1 and the ask price dropped from $3.50 down to $2.25, down to my limit. That's why we like to limit the bid-ask spreads on these positions. It's also, but of course, this one here, $1 bid-ask spread might be too restrictive. If you are looking for stocks, which we're not, I'm sorry, but if you're looking for stocks that are in the $400, $500 range, you've got to accept a bid-ask spread of $5, $6, $7. That's just inherent. Okay, that's going to exist. So it depends on what kind of stocks you're looking for. This is why I tend to use the percentage. Oh, sorry, I'm not on the screen anymore. Normally, I don't like to use the hard number. I like to use the percentage in that case because that opens it up a little bit more. But again, if I know I'm trading covered calls or married puts under $85, I probably want the bid-ask spread to be less than 2 in that case. Just means you're likely to get a better fill price. You're not fighting against the market maker. Always have to be wary too of positions where if you're looking at an in-the-money call for buying or selling, Richard, where the bid is below intrinsic value. Because you're going to, if you're not careful and he doesn't give you the bid-ask spread and you keep lowering it, and you say, yeah, I got $4.20 for it, then you realize you're right at intrinsic value. That's kind of dangerous. So that's our stance on it. That's why we like to limit the bid-ask spread, is to get better fill prices in that case. And in every search, you're going to be able to stand by the percent bid-ask spread or the monetary bid-ask spread as well. I usually try to stick with the percentage bid-ask spread in that case. Okay? All right. All right. Great question here. We're going to switch ideas for a moment. We're going to stay. We've been talking about covered calls here for a little bit. While we're on this basic concept, this market concept, I did see another question come in that I think got removed. Yes, James, I'm going to get to yours, and Octavia, I was going to get to yours. How did it remove itself? I didn't delete it. I believe Fernando asked, how is the implied volatility calculated on Power Options? Why is he asking that question? Well, if you use another service, and I know you do, Thinkorswim, or if you're using another brokerage, you look at Power Options change and you see a certain delta and a certain implied volatility. And you look at Thinkorswim and their implied volatility is a little different. Their delta is a little bit different. What that comes down to is basically the time frame for the underlying security that's used in the calculation. Okay? The delta is calculated using the similar characteristics as the Black-Scholes pricing model. What is the current stock price? What are the days remaining to expiration? Is the option, how far into the option in the money and out of the money, the volatility of the security and so forth. And that gives you, those 5 factors that they calculate gives you the Black-Scholes theoretical price. Similar calculations are used for delta to say that, okay, well, here is this, and if the stock moves up 1 point, what do we expect the option price to change to? It's calculated in that way. Now, to calculate the implied volatility, you need the volatility. And the main question, of course, then becomes, what time frame volatility are you using? Okay, let's just use APA, and I'm going to go to the stock quotes page. So there's 20-day volatility, 50-day volatility, 100-day volatility, 250-day volatility, okay, and so forth. To calculate the implied volatility, you need to calculate the volatility. In Power Options, we use the 50-day volatility for those calculations. Thinkorswim might be using a 90 or 100-day volatility. They might be using a 20 or 30-day volatility. They might be using the 250. I'm not sure. Okay, I can just tell you that we're using the 50. So if you see a discrepancy of what you think on a delta price or volatility number, it's based on the days that were determined to use in the calculation. There is no one standard. Some services use the full year. We think that's too smooth. We like to stay with the 50-day volatility in that case. Okay, so Fernando, I saw that question and then it disappeared from the roll call, but I did get a chance to answer.